All right. Financial instruments, one of the most crucial standards in F7, in SBR, in AAA, in your practical job as an auditor. If you're working in the finance sector, if you want to work in a bank, if you want to work, you know, uh, in any other financial sector company, right? In an investment house or wherever, right? This is the most crucial standard for these industries and for your paper. Okay. Financial instrument is dealt through three standards. Number one is IS 32, which deals with the presentation and classification of a financial instrument. Obviously, I haven't defined what a financial instrument is, but the point is that it deals with the presentation and classification of the financial instrument, how to present it and how to classify it. Okay, whether it's a financial asset, a liability, or equity, whatever. Okay, IFRS 9 deals with three major areas. Number one, subsequent, once you've recognized the financial instrument, right? First of all, initial recognition, at what value will you recognize it? So it's all about measurement. Okay, your initial recognition, at what value will it be, right? And then your subsequent measurement, how will you measure it subsequently? Then it deals with impairment and it deals with hedging. Impairment and hedging are not part of your course, they're part of SBR. All right, so we won't be discussing that. And there's a third standard, which is IFRS 7, which is on the disclosures of financial instruments. All right, even that is not, it's part of your course, but it's not testable, right? It's I guess it's, in fact, it's not testable at all because it's entirely disclosure based. All right. So it tells you how to, what disclosures to give, how to form disclosures, what should disclosures look like, what should be the scope of disclosures, everything within that domain. Now, the first standard, the first very crucial standard is IS 32 that you need to know about. All right. Financial instrument presentation and classification. Okay. Now, in front of you, you have definition of a financial instrument, right? What is a financial instrument? Financial instrument is a contract, right? It's a contract between two parties, all right? That results in a financial asset of one party and a financial liability or equity instrument of another party. Financial instrument is a contract that results in a financial asset for one party and financial liability and equity instrument for another party. So it's asset on one side, liability or equity on the other side. Now the point is, there's a very big debate going on in the world currently. Debt versus equity. What is to be classified as debt and what should be classified as equity? That is, what should be classified as a financial liability and what should be classified as an equity. All right, let's first discuss what a financial asset is. Cash is financial asset. All right, cash is financial asset. Anything that is equivalent to cash is financial asset. Anything that is equivalent to cash, for example, short-term investments, financial asset. All right, right to receive cash, which is in the basic format that we know is trade receivable, right? Trade receivable is what? It's a right to receive cash, right? You have, when you show, for example, $50,000 trade receivable, that means someone owes you $50,000. That means you have a right. If it's a liability of the other party, it's your asset, right? So you're owed $50,000. An equity instrument of another entity is also a financial asset. An equity instrument of a company, for example, I bought shares of XYZ company, they're my financial asset. Yes, equity of the counterparty, but my financial asset. All right. Definition number 4 and 5, you're not tested on that at this level, but if you know it, it's good, but you're not tested on it. All right, it's tested in SBR. You're tested on these three definitions, not theoretically, the application of it. Okay. Definition 4 is right to receive another financial asset from another entity, that is, right to receive financial asset of another entity, or to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to us, favorable to our entity. Okay. Fifth one, you can leave it out entirely because it's not something that you'll come across. Okay, at this level. Now, financial liability. Okay, if right to receive, obviously cash is financial asset, and right to receive cash is a financial asset. That means obligation to pay cash or obligation to deliver cash becomes a financial liability. Now, it's not just cash, it's financial asset as well. Okay, so for example, let's say uh, we'll study this element of factoring, right? If, for example, a party asks me to sell them, let's say I want to sell my receivables, right? What will I do? I'll give them my receivables so they can go and collect them, and they'll pay me a certain amount for it. Okay, so similarly, let's say if I'm the factor, right? It's called a factor. If I'm the factor, okay, and I have taken up a company's receivable, now I owe them money, right? So the receivable were basically the financial asset of a counterparty, and since they've transferred it to me, I owe them some money. Okay. To exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity. So it's entirely opposite of financial asset. All right. Definition 2 and 3, again, not very important at this level. Okay. What is equity? Equity is basically any contract that reflects or that evidences a residual interest in the net assets of the company. If I am an ordinary shareholder, right, that means am I entitled to fixed dividends? No. Am I entitled to cumulative dividends? No. Am I entitled to any interest? No. Am I entitled to the first payment once the company is liquidated? No. Right? What am I entitled to? I'm entitled to the residual interest in the net assets. That means once you have the net assets, once net assets have been realized, so whatever is left of it, you are entitled to that. If there's something, if there's nothing left, your entitlement is gone. That is why we call ordinary shareholders as the real owners of the business, right? Ordinary shareholders are the real owners. Preference shareholders, why don't we treat them as equity? Because that does not reflect residual interest in the net assets. It might reflect interest in net assets, but they still have entitlement to the net assets before the ordinary shareholders do. Okay, that's why they treat it as debt, liability. And obviously if it's redeemable, then automatically it's liability, because obviously for a company it's, and plus you might have fixed dividends, you might have cumulative dividends, right? So redeemable at any point in time, the preference shareholder can ask for their money back, right? And that is why we treat them as a liability, because it is an obligation. If a shareholder asks for his money back, what do we do? What does the company do? Company asks them to, let's say, exchange with some other shareholder, or let's say you can go and, sell it in the stock market, right? But we don't have any obligation to pay you your money back, right? But in this case, in preference shares, right? We have an obligation. Company has an obligation to pay back the money, of the preference shareholders. That means it's not an equity, it's a liability, a financial liability. All right. Again, definition 2 and 3, we'll study that in SBR. Equity versus liability, it's in fact a current issue in SBR as well, right? But in F7 level, right? The reason why I'm basically teaching you from this sheet is because you should know most of the things from it, right? We cannot risk to eliminate stuff. Now, equity versus liability, you can read it. I've already told you the difference. You can read it once I send you the sheet. Okay. Just note down the things that are not relevant, that I'm telling you it's not relevant. You can just note them down and cancel it out. All right, while revising it. Now, issue cost, interest, and dividend. Obviously, when you issue a bond, you incur some issue cost. When you issue some equity, you incur some issue cost, right? Similarly, from a bond, you receive interest if it's an investment, and if you are giving out a bond, that means you're raising finance through a bond, you're paying interest. Similarly, if you're issuing equity and you're collecting money, you're raising money, you have to pay out dividends, right? For financial liability, for a financial liability, everything is charged to profit and loss. For a financial liability, everything is charged. For example, bond, the issue costs, the interest, they already charge to finance costs, right? You guys know that. But let's say for issue cost or dividends of a share issue, they're charged to equity. You guys know that we don't adjust the dividends in the P&L. We set it off against the retained earnings. Correct? You guys know that? Dividends are deducted from the retained earnings, not from the P&L. They're not an expense. Dividend is not an expense. It's distribution of profits that the company has earned. Okay. Now, compound financial instrument. Let's see what this is. Let me just come back to it. Okay, compound financial instrument. And let me just discuss one more thing before I go on to this. Just give me a second. Now, what is exactly a compound financial instrument? First, we need to understand that. A compound financial instrument is an instrument that has both liability. Again, the fight is between liability and equity, right? So an instrument that has both a liability component in it and an equity component in it, right? For example, convertible loan notes. What is a convertible loan note? Can any one of you tell me, please? Unmute yourself and tell me what is a convertible loan note? Guys, you still with me? Harsha, can you tell me what a convertible loan note is? Hello? Can you hear me?
Short-term debts which can convert into equity.
Okay, that's correct. Harsha, you know about it? All right. Now, basically, convertible loan notes are that, like Asif explained, you issue loan notes, right? For example, 3 years, 4 years, 5 years, 10 years, whatever it is, right? You issue the loan notes and you give an option to the loan note holder, bond holder. You tell them that at the end of the term, which is the maturity, right? You can either get your cash back from me, right? So, for example, you took out a loan, you raised a loan of, let's say, $100, right? And you issued one certificate of a bond, right? Now you can give them an option to, give them their $100 back plus interest over the period of time, right? Or they can convert it into shares equivalent to the whatever the basically ratio is. It's pre-decided. The ratio is pre-decided. Okay. So for example, for one certificate, you'll get one share. So that's 1 for 1, right? Now the point is you have both the options. IAS 32 tells you, since obviously you for a company who's raising the loan, they know that the bondholder can exercise this option and dilute what? The ownership of existing shareholders, right? So a compensation is taken by the company against this issue of shares, which obviously is not bifurcated from a business point of view, but from accounting point of view, it needs to be bifurcated. How do you bifurcate it? Let's see. Now, the accounting that we apply in this case is called split accounting. All right. What is it called? Split accounting. All right. Okay. So over here, for example, right? Let me just remove this. Let it be. Now over here, for example, you have 100,000 loan note, right? Which has a maturity of 3 years. Okay. And the coupon rate is, for example, the coupon rate is the rate written on the certificate, right? And let's say the effective interest rate, which sometimes can also be equal to the market interest rate that says 9%, right? It's equal to 9%. Okay. So effective interest rate is 9% and coupon rate is 6%. The loan is and it's a convertible loan note. All right. It's for $100,000. All right. IAS 32 tells us to treat it as a normal loan. Normal loan. Forget the conversion option. All right. Treat it as a normal loan. Okay. What you do is you just mark out all the payments that you need to make. As a company, you mark out all the payments you need to make. So for example, in the very first year, this will be 100,000 into, remember one thing guys, and I'll tell this to you after we done this. Interest payments or interest receipt, payment and receipt, okay, is recorded at par value into coupon rate, or nominal. Par value is also called nominal value, right? So par value into coupon rate. That means whatever is written on the certificate, that is what you will get over the period of time, or that is what you will pay over the period of time. Okay. But interest expense or interest income is recorded at effective interest rate or market interest rate. Note this down. Okay. I'll repeat. Interest payments or interest receipt is recorded at nominal value, that is par value, into coupon rate. right? But interest expense or interest income is recorded at outstanding value of the loan into effective interest rate or market interest rate. Okay. Now, what you do is 6,000 is the first payment that I'll make because that is the par value into coupon rate. Second payment will be 6,000, right? And the third payment will be 6,000 interest plus 100,000 of principal that I'll have to pay back. Correct? Now what I'll do is I'll discount it using the effective interest rate because obviously all future liabilities are to be discounted. You have studied that before in IS 16 as well. All future liabilities are to be discounted, right? I'll discount it not using the coupon rate, but using the actual market rate. Okay. So if I want to discount it, I've already applied the formula over here, right? So this is the formula. And you get the present value of future cash flows as 92,406, whereas you raised the loan equivalent to $100,000, correct? You raised the loan equal to $100,000. The remaining balance is your equity. The remaining balance is your equity element. All right. The double entry that you'll make for this is bank debit because you received 100,000 in the bank. Liability is not 100,000. It's 92,406, which is again equivalent to what? Present value of all future cash flows. All right. And equity is 7594. All right. Now, just to issue this certificate, this bond, you incurred a $1,000 issue cost. To raise $100,000 in loan through this certificate, through the convertible loan note, you incurred $1,000 in issue cost. You guys know that the issue cost related to the financial liability element is charged to P&L, and the issue cost related to equity element is charged to equity, that is retained earning. All right. So over here, what you'll do is, since you've paid out that 1,000, right, you will take the ratio. I've taken the ratio over here. So this is 92%. Loan is 92% of the entire amount, and equity is 8% of the entire amount. All right. And similarly, 8% of 1,000 goes into, you debit the equity and you debit the P&L by 92% of $1,000. All right. You guys get it? To raise 100,000 finance through this certificate or through this, let's say, company incurred $1,000 issue cost. All right. Correct. That means the company paid $1,000 from the bank. So bank credit, you get this credit part. Divya, do you get this credit part?
Yes, sir.
All right. Now,
Yes, sir.
as for the debit part, what will you debit? Should it be charged to P&L or should it be made part of equity? Should it be charged to equity? Again, the answer is in the loan note itself. Is the entire loan note being treated as a financial liability? Is the entire amount being treated as equity, or there's a split in both of them? You're applying split accounting, right? That means the percentage of The percentage of proceeds that are being treated as loan, right? You will allot or you will allocate that percentage to the issue cost as being incurred for the purpose of raising the loan. And the percentage of proceeds being treated as equity, which is what? 8%. 7594 divided by $100,000, right? 7.59% basically, 7.6%, right? That means that 7.6% of the proceeds are being treated as equity. In order to raise that equity, you incurred an issue cost of how much? 7.6% of 1,000, which is equal to 76. Get it? That means a charge to equity equivalent to 76 and a charge to P&L, which is related to the liability component of 924. Okay?
92%.
Exactly. Now, you'll get this stuff better before once I do these examples with you guys. All right, these two examples I've made for you, right? Before we move on to the examples, there's one more thing that I want you to know is offsetting. Right? What is offsetting? Offsetting means that, for example, I have a receivable from Asif, but I also have a payable towards Asif. Right? I have a receivable from Asif and I have a payable towards Asif. Okay? Let's say my receivable to Asif is $1,000, $10,000. Payable to Asif is $2,000. That means net receivable or payable? Net receivable, right? Net receivable how much?
8,000.
8,000. Do you think I can show it as a net receivable of 8,000 in my financial statements?
No.
Depends. Depends on what? Depends on these three conditions. All right. First condition is you need to have a legal and enforceable right to offset this amount. Legal and enforceable right means that I need to have a contract with Asif that this amount will be settled on a net basis. It's not like I'll issue you, you'll issue me a check of $10,000 and I'll issue you a check of $2,000. We'll settle it on net basis. We need to have a contract, not a verbal one, a written, documented contract. Okay? Counterparty should be the same. This is another clause. Counterparty should be the same means what?
Intercompany.
Intercompany, but same parties. Now I'll give an example on this. All right. Settlement is done on a net basis of both amounts are settled simultaneously. So settlement is done on a net basis means that you have a past practice, that Asif and I have a past practice of settling it on a net basis, right? But past practice itself is not sufficient to offset the amount in the balance sheet. Why? Because we need to have a contract for it.
Contract.
Okay. Now counterparties should be the same. Let me explain you an example on this. You see, in majority countries, right, where there's tax, right, you have two different tax authorities. One tax authority is responsible for collecting the sales tax, that is your VAT, right, VAT, and the other tax authority is responsible for collecting the income tax. So one is responsible for collecting the indirect taxes, which is your VAT, and the other one is responsible for collecting the direct taxes, okay, which is the income tax or corporate tax, for example, right? Now, receivable. Now, both of these organizations are government organizations, all right? So, receivable from, let's say, direct tax authority, I have a receivable of 2,000, right? But I have a payable towards indirect tax authority of, let's say, $15,000. Do you think I can net this off and show $13,000? No. Why?
It's separately. Yes.
Number one, do I have legal enforceable rights? Let's say I have them, right? But the point is the counterparties are not the same. You will never have legal enforceable rights with the government to set off the net amount of two different organizations, right? Even though they both are government departments, they both come under the government, they both are treated as a government organization, right? They both are public sector organizations. But the point is, they are two different entities, okay? It's not a single entity. So it's not like, I cannot, if I net it off, it means that I'm paying 13,000 to the indirect tax authority, to the sales tax authority, even though I owe them 15,000, I'm paying them 13,000. I'm asking them to collect the remaining 2,000 from the income tax authority. I cannot do that. All right. So offsetting, you need to satisfy all three conditions simultaneously. All right. Treasury shares, putable options, these are not putable instruments, these are not part of your course. So we'll discuss them in SBR, right? You can cancel it out. Now this is where I tell you exactly how to work out an investment in bonds, or when you've raised money through bonds or loan notes, you've basically taken on a liability, how to treat it. I've written a term over here, which is what? Deep discount bonds. What are deep discount bonds? Bonds that are issued on a discount, right? Now the discount could be in the par value, right? Or in the coupon rate, or in both, right? When this happens, when there's a discounted bond, the rate that you're giving, that at which you're paying the interest basically, which is a coupon rate, will always be different from the effective rate. And effective rate is calculated. Obviously, it will be given to you in the exam, but the point is, it's calculated. All right. What does an effective rate do, and why do we calculate effective rates? Effective rate helps us to spread four things over the life of the bond. So it could be, again, it could be an investment, or it could be a issuance of loan, right? So for example, now there are four things: physical interest, which is what I just told you guys, coupon rate into nominal value or par value of the redemption premium. That is, if any premium you're paying at the time of redeeming the bond, that is the time of maturity, discount, and where is this, issue cost. All right, these four things are spread over the life of the loan note through effective interest rate, right? Let's look at an example and we'll see what I'm talking about. All right, so I'm doing the first example. All right, balance brought forward, interest, since I've made an investment, it will be an interest income, right? Interest received and balance carried forward. All right, so these are the four headings. Now look at the example on the left. Investment in 8% loan notes Purchased at what value? Purchased at what value?
400.
Sorry?
Four-
400,000,
400.
right? Transaction amount is how much? Transaction cost, sorry.
$2,000.
2,000. How much is the discount?
$1,000.
What is the redemption premium? 27,881. And what is the effective interest rate?
10%
Per annum.
per annum.
Per annum. And what is the maturity period?
Mm.
3 years. Right?
Yes.
Technically, how much did I invest? How much did I invest technically? So $4,000, $400,000, right? Got a discount of $1,000 and incurred a transaction cost of $2,000. Now it's a bond we're talking about. All right. We don't capitalize it. The issue cost is not capitalized. The transaction cost is not capitalized. All right. Obviously, there is no issue cost over it. It's transaction cost. So technically, 400,000 minus 1,000 minus 2,000, right? Oops. That's 397,000. Correct? Interest income is on effective rate of outstanding balance, and interest received is coupon rate into nominal value, which is par value. So 400,000 is the par value and coupon rate is 8%, right? Now, interest income is 397,000 to 10%. This was the outstanding balance. This is what I should have received, and this is what I actually received. That means the total outstanding balance will be 404,700, right? Which will be brought forward at this date. Okay. Again, this 32,000 stays the same. It does not change. All right. Similarly, this stays the same. This stays the same, does not change. And the formula over here. Okay. Get it?
Yes, sir.
But maturity is what? 3 years. So, okay. So we're working for 3 years only. All right. I guess I changed the values. That why I haven't updated this. Redemption premium will be 22487. How do I know it will be 22487? Because at the end, I will get this amount. Correct? At the end, this is what I'll get. So 400,000 was the par value, whereas I'm getting what?
422.
487.
Correct?
So, okay.
What is the discount?
1,000.
What is the issue cost?
Transaction cost is 2,000.
2,000.
Right? And what is the physical interest? Physical interest is this, right? 96,000. I guess. So 96,000, right? You see this?
Yeah, correct.
What is this? Redemption premium. What is this? Discount.
Discount.
What is this? Transaction cost. What is
Transaction cost.
physical interest?
Interest, physical interest.
You sum it up, and this is what your total interest income has
Interest
been.
income.
How? Because of the effective interest rate.
Right.
So these are the four things that are spread through effective interest rate.
Interest rate.
Okay, guys, do you understand this?
Yeah.
Harsha?
Yes, sir.
All right. Now I want you to try this question, right? Do it on Excel, please. Don't do it on a piece of paper. Papers and pens are obsolete now. Okay, so forget papers and pens. Take out a laptop, do it on Excel so that you can easily practice it, right? This is a question I'm giving you guys 10 minutes, solve it, and I want you to get this figure and this figure matched. All right, so I'll just highlight it. And it should match, okay? A loan note, you have a 6% loan note, right? Headings will be the same, correct? At what value did you start?
1,000.
Sorry?
100,000 minus 9,000, right?
9,000, discount you got 5,000, and
Plus
transaction
transaction
cost was
cost.
4,000, correct?
Yeah.
4,000.
91,000.
Maturity date is how much? Maturity period is 3 years. So
3
this is
years.
first year. Sorry, this is first year, second year, and then third year.
And third.
Interest income will be at 10%
10%.
effective rate,
Yeah.
and interest
10%.
received will be
6%.
100,000 into 6%, not just 6%.
6%.
Yeah.
Yeah.
All right. Now, interest income is this into this.
10%.
Correct?
Yes.
91,000 plus 9,100 is something that you should have received, whereas you received
Yeah.
1,000. Right? Okay.
Yes, sir.
Now, the redemption premium, again over here, I guess it's mentioned incorrect. It's 1261. I changed the question for you guys. That's why I guess. All right. So redemption premium is 1261, right?
One.
Now, minus 100,000. Sorry, minus 100,000. That means you get this as 1261, your redemption premium, right? Discount was how much?
It's 5,000.
5,000. Issue cost was how much? Transaction cost, sorry, not issue cost.
4,000.
1,000.
Remember, if the amount is not coming same, right? That means the effective interest rate needs to be adjusted for something. So physical interest. So the total is,
28,000.
right?
Oh, now it's okay, sir. Now it's okay.
Okay.
Yeah.
Where did you go wrong?
With this effective, the redemption premium, the amount
Okay.
is 1,009.
All right.
9 you say.
All right. Okay. Now you get it?
Yes, sir.
Sure. All right. Let's move on to the previous example that we did. Sorry?
That redemption rate, how much it came? The previous one, just now we sold, right?
Redemption premium 1261.
1261, but it's actually it is 11,000 something, right?
No, that was a mistake in the question. Again, like in the previous question, I asked you to. I changed the question for you guys. That's why I probably didn't update that.
So redemption rate is 1261, huh?
Yes.
Okay,
Are
just
you
wait.
getting Are you getting right answer now?
Now, just one minute, sir. Uh, 1261. That is 28,261. Yeah, it is getting now. Now it is getting. Yes.
All right.
Now it is getting. Okay, thanks.
Okay. Now, this was IS 32.
2.
Yes.
Yes.
Now we have to look at IFRS 9. IFRS 9 is very limited in your case, right? At what value will you recognize a financial instrument? At fair value. Each and every financial instrument will be recorded at fair value initially. Okay? You guys get it? And the fair value will be calculated according to IFRS 13. Remember IFRS 13? You guys remember IFRS 13? Okay. Now, when we talk about financial liabilities and equity, right? Again, it will be recorded at fair value, right? Subsequently, financial liabilities are revalued depending on, whether it's a derivative nature liability, a fluctuating liability, right? If it's not, you record it at amortized cost. Amortized cost is the way we just looked at it, right? It's the same as we just looked at. Okay. With regards to financial liability, you don't have a lot of testing material.
Mobile.
Can you please mute yourself? Okay, with regards to financial liability, you don't have a lot of testing material. Okay, that means it's not highly tested. The fair value through P&L category is not tested, right? But yes, amortized cost. Amortized cost means what? Spreading the cost over the period of the loan. And that's what we did. That's what we just did, right? If it's an interest income for me, it's the same interest expense for the counterparty, correct? An interest income for me is an interest expense, let's say for Asif. Okay. The point is about financial asset. Now, financial assets are a bit detailed. You have two categories. You can either invest in a bond from which you'll get interest income, or you can invest in shares, which is you'll get probably dividends, right? If you're investing in bonds, you have three categories that you can classify your financial instrument in. Category number one, amortized cost that we just studied, the calculation for which we just studied. All right, amortized cost. What is that? Spreading the cost over the period of the loan, right? But you have to satisfy certain conditions if you want to classify your investment in debt, investment in bonds, investment in loan notes under amortized cost. What are the criteria? There are two criteria: business model test and contractual cash flow characteristic test. All right, business model test and contractual cash flow characteristic test. Business model test says that if you have the intention to hold the bond till maturity, only in that case you can categorize it at amortized cost. One condition. Condition number two, contractual cash flow. A standard bond contract only has two cash flows: interest and principal, nothing else. There is no hidden option. There are no other payments. There is no option to convert. There's no other option except for standard interest payments and principal. All right. If the bond is of such a nature, yes, you can classify your investment in debt as amortized cost. The only thing that will be charged to P&L will be your interest income, because it's obviously an investment, right? So the only thing that will be not charged, basically taken to the profit and loss account as an income, will be what? Your interest income. Okay. Amortized cost is the least uh, you know risky category. Coming to this is one extreme. Amortized cost is one extreme. Coming to the other extreme category, which is fair value through P&L. If you have invested in the bond to take advantage of short-term gains, I'll repeat. If you have invested in the bond of a company, Asif as a company, I have invested in the bond, Asif has raised some money from me, but I don't intend to keep it till the end. I will sell it in the open market if I get a good price for it. All right. That means my intention is not to hold it till maturity. That means the business model test doesn't satisfy. Or if the bond in itself is of a nature where the contractual cash flows are other than interest and principal, for example, convertible loan note, then because of the bond, because of nature, I cannot classify it at amortized cost, and I have to classify it through other two categories. We're discussing fair value through P&L right now. All right. What do you do in fair value through P&L? At every year end, you calculate the fair value of your investment. And since it's through P&L, any changes in the fair value of the bond are taken to P&L. If if the investment value increases, investment debit, P&L credit. If the fair value of the investment falls, P&L debit, investment credit. Simple. Middle category. Now these were the two extremes. Amortized cost is one extreme. You want to keep it till the end. You don't want to basically touch it. Okay. But in fair value through P&L, it's short term. It's all about anomalies, right? Taking advantage of the anomalies. But fair value through OCI is the category which denotes that you might want to sell if you get a good price. But right now, my intention is to hold till maturity. My intention is to keep the bond as long as I don't get a good price. Yes, if I get a good price during this period, I'll sell it. If not, I'll keep it till maturity. This is, if the intention is such, this is when you classify a bond at fair value through P&L. Any subsequent changes in fair value will be taken to OCI. All right. Did I accidentally say P&L? If I said that, I'll correct it. Any such bond is categorized at fair value through OCI, and any changes in fair value will be taken to OCI, other comprehensive income. Get it?
Yeah.
This is the debt category of investment, debt category of financial asset. Let's look at the equity category of financial asset. Two models. Now, in the debt category, there is no default category, right? Because it depends on the intention, right? But in the equity category, the default category is fair value through P&L. Okay. Fair value through P&L is the default category. So there are two categories, fair value through OCI and fair value through P&L. I have invested in shares of Asif's company, Asif and Company Limited, right? I have the shares. I can classify it at fair value through P&L without any elections. Election means you basically nominate your investment to be classified at on the other category, right? But if I don't, that means it is fair value through P&L. At every year end, I will basically take the changes in fair value to P&L. But if I make an election, and this is a short, remember fair value through P&L is always a short-term category. If my intention is to keep it for short-term, it's fair value through P&L. But if my intention is to keep it for a long-term, that is for more than 12 months, right? I will classify it as fair value through OCI. All right. But remember, I have to make an election. Election means you have to specifically categorize it in your financial statements that this is a long-term investment, and that's why I'm categorizing it at fair value through OCI.
OCI.
And this election is irrevocable. You cannot take it back. You cannot switch between P&L and OCI again and again. If it's OCI, it's OCI. Okay. And there's a separate issue that, what if you breach that condition? What will the auditors do for the next period or the period after that? We'll discuss that when you're doing probably SBR or AAA. All right. It's not relevant right now. Okay. You guys get it? Guys, you get it?
Yes.
All right.
Yes, sir.
Now, impairment is not for you. Financial liabilities, amortized cost, fair through P&L. You just need to know amortized cost, which you already did. You don't need to know the category, right? Derivatives, you don't need to know that. Derecognition of financial instrument. This is something that you need to know, right? Derecognition means hedging. All of these things are out of your syllabus. It's not part of your syllabus. It's one of the biggest standard. Okay. IFRS 9 came in, it became compulsory on 1st January 2017. Okay. And 1st January 2018. Okay. Now, what happened was there was a previous standard IS 39, right? The change was so big between these two standards that the financial industry of UK, United Kingdom, right? ACCA is of UK, right? The financial industry of UK had to record 15 billion pounds of losses in their books. It was such a huge change. 15 billion pounds of loss in their books. They had to record it because of this change. Okay, so it's a very crucial standard, a very big standard, right? In fact, the biggest standard there is. Okay, but we just need to know the chunk because obviously that is only part of your syllabus. Yes, when you come into SBR, it will take approximately 2 or 3 classes, more than that, 4 classes including practice. Okay, because it's a very big standard. Now, derecognition of financial instrument. When do you derecognize? When do you write it off? That is for a liability when your obligation has been extinguished or you have settled. Extinguished means it has been lapsed. You don't have any more obligation to settle off the payment to pay the cash, right? But in the case of asset, right, if your right to receive the cash has expired or you've already received the cash, you write it off, right? You derecognize the financial instrument. Okay. Now, there is a case that I was talking about, factoring. What is factoring? So for example, now there are companies, right? I'll just write it down over here for you guys. Factor, right? Now Factor is a company, right? What does it do? It's an expert at recoveries. All right. Factor is an expert at recoveries. Okay. What the only job is to earn through recoveries. So for example, you have an outstanding receivable for the last 6 months and you're not able to locate them. You're not able to recover money from them. You're not able to, contact them. What you do is, because obviously it's a receivable on your books, you need cash, right? You sell these receivables to the factor. What do? You sell these receivables to the factor. Now, obviously, how do they earn? Let me explain you the business model. They earn through, you know, for example, the receivable is $1 million. Okay. They'll pay you $800,000 and they'll recover $1 million from them. So that the difference of $200,000 is their fees. That is how they earn. All right. They'll not pay you the entire 1 million. They'll pay you 800 and they'll recover 1 million. And that 200,000 difference is their fees. Get it? This is the business model. And this happens a lot in the world. All right. Insurance companies are involved in such businesses. What happens is there are two cases of factors. There's a factor with recourse and there's a factor without recourse. Now, what is that? The case that for derecognition, the case that is important is this one that I'm telling you. Factor with recourse and factor without recourse. Listen to it carefully. Factor with recourse means that the counterparty, the factor company that is, has the right to sell these receivables back to me. If they're not able to recover the money, right? Because obviously they have much more resources than we do, right? In the recovery business, they have much more resources than we do. They try to exploit all the resources, but if they're not able to recover their money, they sell those receivables back to us. And we have an obligation to accept it. It's in the contract. This is called factor with recourse, right? It's basically that we don't have insurance in the case of factors, in the case of a receivable, sorry. Basically, our receivables are not insured in that case. This is one way of interpreting it, right? Factor with recourse means, now a lot of, in the exam, you'll get a case where, you know, there will be a factor with recourse and obviously your receivables won't be insured. And what you'll do is, once you've sold it to the factor, you'll derecognize. The examination question will tell you that they've derecognized the receivables. Do you think it should be derecognized? Do you think it should be derecognized? Any one of you? Yes or no? Should I derecognize my receivables when it's a factor with recourse? Yes or no? Come on, guys. Just one word answer, yes or no. You have all the right to be wrong. It's okay.
Yes.
Yes. All right. Divya says yes. Harsha, yes or no?
No.
No.
No, sir.
Okay. No is the answer. Can Asif or Harsha, can you guys please explain why no? Why no? Your answer is correct. I shouldn't derecognize these receivables, but why? Because I still have the obligation to pay this money back. Yes, if the factor tells me that we've recovered the receivables, then I can derecognize them. Okay. But if it's factor with recourse, that means my receivables are not insured, and the factor company can ask me to purchase these receivables back, and it's an obligation on me to purchase it back. In that case, my risks and rewards associated to the receivables still exist. My risk and reward related to the financial asset still exist. So how will we treat the amount that we've received from the factor company for the time being? For the timing, obviously, if I've sold them the receivables, they've given me an amount, right? But actually it is not a sale because there's still risk and reward attached to those receivables. How will I treat that amount? It will be treated as a loan. Essentially, it's a loan. Okay, so you'll make the double entry bank debit and loan liability credit. This is what factor with recourse. Factor without recourse. Factor without recourse. What happens in this case? What happens in this case? Can any one of you tell me?
Is that vice versa?
Vice versa. That means factor now bears the risk of any bad debts. In factor with recourse, I was the one who was bearing the risk of bad debts, because obviously the amount that has not been recovered, they'll sell it back to me and I have to pay them back, right? But factor without recourse, the factor will bear any losses, because now I have detached myself from the risks and rewards associated to those receivables. All right, get it? So that is actually a sale of or derecognition of financial asset, and that is when I make the entry bank debit financial uh, asset credit or receivables credit. Okay, so bank debit, receivables credit. Obviously, you might show the receivables at $1 million and you receive 800,000 in the bank. The 200,000, the remaining 200,000 will be charged to P&L as a loss. Okay, you guys get it, guys?
Yes.
Okay, that's good. All right, so factor with recourse and factor without recourse. Now, in the next class, we'll do the kit questions of IS 32 and IFRS 9, right?